Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you by Baillie Gifford. I'm Jen Frost, editor of Professional Advisor, and I'll be your host for the next hour. Now, before we do get going with today's session, let me quickly run through the usual housekeeping. This session is being recorded. We will send you a link of the recording by tomorrow. Please do feel free to share this with your colleagues. As usual, today's working lunch will count towards 1 hour of CPD. We'll send you your proof of attendance along with the link to the recording of the session, and I'm reliably informed that both should arrive in your inboxes tomorrow. Now, the economic and political backdrop for investors today is uncertain and shows little sign of settling down in the near term. I'm joined today by John Henry, who's an investment specialist director in the client department at Baillie Gifford. From a growth investor's perspective, John will examine how Baillie Gifford navigates periods of uncertainty, retains perspective, and stays the course in pursuit of long-term growth. Please do feel free to put any and all of your questions to John using the chat function. You should be able to find this at the bottom of your screen. If you do wish to remain anonymous, you can select my name, that's Jen Frost, my name, from the drop-down list in the chat box, and then type your message in there so that only I can see it. Now, just before I do hand over to John, I'm just going to quickly run through your learning objectives for today. By the end of this presentation, you should understand the perspective of a long-term growth manager in a rapidly changing world, have considered the importance of investment discipline and a differentiated perspective in delivering a high conviction growth approach, and understand where there may be opportunities for long-term investors amid increasingly volatile global markets. So that's the objectives and the CPD covered. Let's hear from Baillie Gifford's John Henry. Afternoon, John.
Hello, good afternoon, Jen, and thank you very much indeed for your introduction. Indeed, thank you to all of you for joining us today. I'm really excited to be able to share insights from a growth manager's perspective in a world that's been filled with uncertainty, particularly over the last 6 months or so. Now our focus today is on navigating these choppy waters while maintaining a long-term growth outlook. So what I want to do in the next hour or so is share our perspectives on uncertainty and what we mean by uncertainty. Then I'll share what we are putting forward as a three-stage approach or way of thinking about how to navigate uncertainty. And then crystallize really why navigating uncertainty matters for investors, over long periods. Now, I asked ChatGPT recently what Donald Trump would do next. And to be honest, the answer was impressively detailed, covering 8 different policy areas, including defense, energy, AI, and of course, foreign policy. But when we think about how to manage portfolios in a rapidly changing world, we don't tend to scrutinize or rationalize or even preempt the behavior of world leaders or every amendment to policy or to tariffs. Because frankly, we wouldn't know any better than anyone else, be that an algorithm or human. You'll have heard about Donald Trump's Liberation Day in early April, where he revealed a long list of tariffs that the US were going to apply to global goods and services. And I think the breadth and the scale of tariffs took everyone by surprise, including us. But in many ways, I think a lot of what that did was really crystallize or set in context a larger set of geopolitical shifts that have been taking place for a number of years now. So if we move to the first slide, what we're suggesting here is that we're emerging from a period of what we might call the long decade, a period of stable or frictionless trade, low interest rates at near zero or even negative in some cases, to one where there's much greater uncertainty. We've likely all felt the impact of rising rates in some way. Goods are more expensive than they have been in recent years, and we have rising populism, and a sense that there's much greater self-interest at the government level right around the world. Now, all of this matters for global trade patterns, for currencies, for interest rates, and for international relations, but it's really all rather complex. So what do we mean by uncertainty in the first place? Well, firstly, I'd like to introduce you to a very intelligent man indeed, and his name is Frank Knight, and he was an economist. And perhaps his most important work was to distinguish between risk and uncertainty. Now, he used the term risk to denote situations where outcomes and their probabilities are known or can be estimated, like throwing a dice or writing an insurance policy. Uncertainty, on the other hand, it applies to situations where outcomes and their probabilities cannot be reasonably estimated. So risk can be priced and hedged and insured, but uncertainty, not so much. Indeed, Maynard Keynes, the famous economist, his way to describe this was irreducible uncertainty. So if uncertainty is irreducible, how should investors go about managing that? Well, different investors will give you a different answer here. There'll be many ways in which they'll seek to do that. But I want to share our perspective as a long-term growth investor by sharing a three-step framework that helps us position our portfolios today. Now, moving on to the next slide here, that what we're trying to do is use a very simple to say three-step framework, namely that step number one is to build resilience. Step number two is to retain perspective, and step number three is to remain reward seeking. That sounds easy, but what does it actually look like? Well, through the course of this presentation today, I'll seek to demonstrate that with reference to the approach we take in managing the Monks Investment Trust, which, broadly speaking, applies these principles in the management of the portfolio. So, the first principle, building resilience. If we consider the analogy of a diversified farming system, which mimics nature's complexity in building resilience, so growing multiple crops, so that should the barley be blighted by disease on the one hand, there's every chance that the soybean yield will help to offset that. Similarly, when we think about growth portfolios, we look to capture a broad spectrum of growth right through three different growth profiles. So in our case, we're talking about stalwart growth businesses, rapid growth businesses, and cyclical growth businesses. And this diversity really helps us withstand market shocks and seize opportunities. Now, if you've heard from Baillie Gifford before, you will have heard us talk about rapid growth stocks in the past. So these are the most exciting companies that are really harnessing technology to drive change in industries, and sometimes radically so. So, for example, DoorDash, which is a food delivery business in the United States, it's managed to find exceptional efficiencies in the delivery of meals to consumers, such that it's now taken a 70% market share in the industry and delivers an incredible 643 million meals a quarter. So that's really astounding levels of service and efficiency that DoorDash is delivering. Stalwart businesses, these are the understated, get-rich-slowly type of companies that compound their earnings over long periods. MasterCard is the example we've used here on the slide that you can see. It's a great example of a company that we've owned for over a decade. It's rarely surprised us. It's metronomically grown its earnings over time, and it plays a very important role in the economy, providing ballast when the times get really quite choppy out there, and really cash generators within the portfolio. And then finally, on the right hand side, we've got cyclical growth companies. These are typically more economically sensitive. Their growth is not delivered evenly, but they must invest counter-cyclically to be more profitable in the next cycle, And we've used CATL, the Chinese battery business, as an example here, which is subject to huge capital cycles as it invests for future growth. So to give you a sense of that, CATL currently has over 20,000 pending or issued patents in its R&D pipeline, which is a real evidence of its commitment to continued evolution in the electric vehicle and battery market. So external shocks rarely affect all companies equally. So for example, macroeconomic woes will be reflected more by cyclical stocks perhaps, where very fast interest rate changes might affect rapid growth stocks more directly. But by being pragmatic and owning a range of different growth types, we have the adaptability to navigate periods of uncertainty, and importantly, the flexibility to lean in to where the growth opportunities at any point in time are more attractive. Now, of course, owning a diversity of growth really isn't enough. We must invest in companies that are financially resilient, companies that have built-in shock absorbers that can withstand the metaphorical bumps in the road that come in the global economy. Now, I'm talking about companies that are largely self-funding, that are not reliant on debt, that are more profitable and generate higher returns than the market average. And here I'm showing some metrics for the Monks Investment Trust. You can see that these are all superior relative to the broader market. But why does that matter? And I think it matters because it means that we don't have to worry about every twist or turn in the short term, every tariff announcement or every policy change, because margins are sufficiently wide. Companies are sufficiently profitable that they can adapt, change, and remain on course to deliver growth, which is really important when you're a long-term investor and you're looking to manage a low turnover, low change portfolio. So then that takes us nicely to the second step in our process, which is that we're looking to retain perspective. Investors should seek to understand that things are never as bad as they appear in the moment. And the market tends to overshoot and undershoot. Returning to Maynard Keynes, the economist, he called this animal spirits, and I think we all know this. And it's always recognizable in hindsight, but it's rarely recognized in the moment. And I think we could have seen that following the Liberation Day tariff announcements on the 4th of April, that the S&P 500 fell, I think it was 12% in the 2 or 3 days following the announcement, on nothing really other than speculation. So when we seek to retain perspective, we must acknowledge that the limitations of mean reversion in the context of investment markets. If we have a short history lesson in mean reversion, because I think this is an important point. Mean reversion was a concept that was first introduced way back in the 19th century by Sir Francis Galton, who was an English polymath. And Galton's biggest contribution to statistics was arguably his studies on heredity. Now, this is moving away from finance slightly, but it is relevant. He observed that children of exceptionally tall parents, while still taller than average, were closer to the population average than their parents. And conversely, children of exceptionally short parents were shorter than average, but closer to the average height of the population than their parents. In other words, nature exhibits a tendency to revert to mean. And this makes sense, because I think if otherwise, you'd have a population with very large and very small people. But how does that relate to investment markets? Well, the simple answer is that the forces at work in nature are not the same as the forces that are at work in the human psyche, which is much more irrational and unpredictable. So specifically, I think there are 3 issues with mean reversion in investment markets, which really matters in terms of retaining perspective as a long-term investor. The first is that markets tend to overshoot and undershoot, and what you get is a fluctuation around the reversion to mean. The second is that what we can see on the slide here is that while nature has constantly reverted to mean over time, the mean in markets is constantly changing. So if we have a look at the data on the slide here that I'm sharing, Over the 4 decades between 1950 and 1990, we can see an average PE for the S&P 500 of around 13 times. But in the 3 decades since, it's been much closer to 20. So the mean has shifted. And that's an important point to recognize. What do we know? How do we know what the mean is in investment markets? And then thirdly and finally, while large parts of the market might regress towards some sort of mean, market returns over very long periods are dominated by outliers, by a relatively small cohort of companies. Now, again, if you've heard from Baillie Gifford in the past, that you'll likely have heard us talk about the work of Professor Bessenbinder, who in shorthand showed that it's a very small proportion of index constituents of the market that drive returns. So for his studies, which are very long-term in nature, 30, 40, 50 years, he showed that it can be proportionally as little as 0.4% of the index that drives over half the returns. So the message is clear there that really it's very few companies that matter over the long term. These are the outliers, and you must be careful in not regressing to mean. Instead, you should be looking for the companies that break away from that. Indeed, I think the second and related point here in terms of retaining perspective is structural change. And what we're looking at on the slide here is several areas where structural change or exceptional technological or social progress challenges the concept of mean reversion in some way. So the slide here highlights a handful of companies that, a handful of examples where we think that there's likely opportunities that are likely to persist and should outlast political and economic cycles. So for investors navigating an uncertain world, we think being the right side of change like this matters, and it's key to generating attractive long-term returns. So for example, chips with everything is reference to the power of AI, which is likely to unlock huge global IT spending. A recent survey suggests that IT spending could grow to around 60% through to 2030 to a market size of about 7 trillion, which is huge. And there are many ways to build that exposure, from mega cap players like NVIDIA to high-tech picks and shovel semiconductor businesses like Disco Corporation, which makes specialist manufacturing equipment for semiconductors. And that's what we're looking to do within the Monks Investment Trust, is invest right across that value chain within the semiconductor sphere. Emerging consumers further across to the right. There are currently around 4 billion middle-class consumers globally, with around 80% of them residing in emerging markets. But today, the bulk of the spending, around about 2/3, takes place in developed countries. But by 2050, it's estimated that will have flipped. So you want to ask yourself the question, where is the likely dominant retail platforms in emerging markets that will be able to grow into that tailwind? So one company that we like is Coupang in South Korea, which currently has a stranglehold on the e-commerce market. 70% of the South Korean population lives within 10 minutes of a logistics center, which ensures that the deliveries are made within 24 hours, 99.6% of the time, which is phenomenal. And then thirdly and finally, I was going to touch on electric futures as another example of a structural growth area. And I'm going to introduce here, if I can, a poll for you to consider. And what I would like to do is for you to consider what proportion of electric, what proportion of total cars on the road will be electric by 2030. So you should be able to see a poll on your screens just now and select the option from that. But what is true, almost regardless of the outcome here, is that huge infrastructure spending is going to be required in order to provide the support required for electric vehicles, for battery storage, and so on. What we're doing is really looking for the less obvious beneficiaries of this. We're thinking about areas like utility poles. So, for example, Stella Jones is a Canadian utility pole business that has a 70% market share of the US market. And what we're looking at here is the opportunity that the upgrade and renewal of the grid in the US is critical to building out the infrastructure required to support the growing demands of an increasingly electric world. So we've got to look broadly and widely for where the opportunities are within these deep structural growth areas. So if I update the results here, I can see that most of you think that it'll be 1 in 10, which is not quite right. Some of you think 25%, 1 in 6, 25%, 1 in 20. It is indeed 1 in 6 will be cars on the road will be electric by 2030. So there's a huge tailwind for companies that are in some way plugged into, no pun intended, the electric vehicle story there. To give you a brief recap, I think this is important before we move on to the third step. Step number 1 is to create a resilient ecosystem that can withstand shocks. Step number 2 is to retain perspective. And step number 3 is to be reward seeking. So behaviorally, being reward seeking is arguably one of the hardest things to do. The basic principles of sound investing are pretty straightforward. You want to buy low and sell high. But adhering to those principles in the face of market shock fluctuations and emotional impulses is anything but straightforward. I think there's psychological safety in making the same decisions as everyone else, even if those decisions are ultimately wrong. This has led to a degree of herding behavior, which partly explains why markets overshoot and undershoot. But conventional behavior will really only lead to conventional and very ordinary results. Therefore, investors must remain reward seeking through periods of uncertainty. And that does not always mean doing something. Inaction, choosing to do nothing, is also a decision, but you must be active about that. For example, we made relatively modest changes to the Monk's portfolio following the turmoil we saw following Liberation Day in early April. And the action that we did take, we sought to take very deliberately where we've seen opportunity. For example, we can see a scenario where discretionary spending for consumers may come under pressure for a period of time. Therefore, we sold Yeti, which we owned in the portfolio. Yeti is a high-end drinksware business. But fundamentally, we think it's less likely moving forward that people will be willing to spend £300 on a water cooler in the US and in other markets around the world. And instead, we've recycled that capital in our portfolio into Dollar General, a discount US retailer. And Dollar General sells staples. So I'm talking here about very glamorous items like toilet roll and baked beans, largely non-discretionary in nature, but it does address an underserved rural market in the US. So what we're seeing here is the opportunity is that if tougher times are ahead, at the stock level, we think Dollar General is it's well-managed store network, its critical proposition of staple goods that people need all the time, and its convincing store rollout story should mean that actually that's a better place to park our investors' capital within the portfolio rather than in a highly discretionary drinksware business. Elsewhere, we've taken the opportunity to add to holdings where fundamentally nothing's changed, but where the share price has been volatile. And that was the case for Nvidia, which we own in size within the Monk's portfolio, but its shares fell to $95. We added a significant portion to the portfolio at that point, and the stock today is priced at about 177. So you can be opportunistic and you can invest on the back of strong fundamentals, which are not reflected or indeed under reflected in the stock market through periods of uncertainty. So let's recap just at this point. In an increasingly uncertain world where there are three things that you can do when you're considering your wider portfolios and asset allocation for your clients. The first is to think about the resilience of your overall portfolio. Build an ecosystem of differentiated growth drivers and bear in mind the importance of financial resilience and quality over the long term. That gives companies at the stock level, at the company level, greater flexibility and adaptability. The second is to retain perspective. Be wary of mean reversion, look for the outliers, look for the winners, and be aligned with long-term structural trends that will outlast political cycles. And then thirdly, remain reward-seeking. Don't follow the herd, be unconventional, and act with intention. Through periods of significant uncertainty. But the big question is, why do that? And I think that can bring us back around to the final slide here. You want a resilient and a differentiated and reward-seeking approach. And in short term, it's hard to say. But over the long term, we think by following these principles, it can bestow us a portfolio that's well positioned to deliver capital growth. That's what we're seeking to do in investing here, in a wide range of macroeconomic outcomes. And I suppose this could be applied to how you align your client portfolios for growth or for income or anywhere in between. In our world, as we seek to grow capital, the outcome of holding true to these principles can be seen in the positioning of the Monks portfolio today. We own a unique blend of growth companies, like I've talked about, across 100 or so stocks, balanced across these different growth profiles. But importantly, the portfolio's valuation today is very modest, a small premium to the index, while its forecast earnings are significantly greater. So the forecast earnings growth of the Monks portfolio is around 40% today. So you're not paying very much to get much better future growth. And I think to bring it back around to Frank Knight, the economist who made the distinction between risk that is measurable and uncertainty that is not. He argued that true profits, or what he called entrepreneurial returns, arise precisely from being able to bear uncertainty rather than just risk alone. Because uncertainty can't be perfectly forecast or hedged, it is the entrepreneurial willingness to operate under these conditions of genuine uncertainty that yields the greatest profit, the greatest returns for investors. And I think that encapsulates the spirit of what we're trying to do as a growth investor in an uncertain world. So with that, I'm going to stop there. And I believe we have some Q&A that we'll work through with Jen. So please do get your questions in.
Thanks very much, John. Great presentation. We do have some questions that have come through. Just a reminder to everybody in the audience, you can submit your questions in the chat at the bottom, or if you're a bit shy and you want to stay anonymous, you can send them to me directly. So we've got one here from Christian Frank, and apologies if I'm a little slow on this one. Just it's quite a long question. There we go. So John, how can a high conviction growth strategy help clients aiming for early retirement, who are, say, in their 50s, to stay the course during periods of market volatility, especially when their time horizon feels shorter than traditional long-term investors?
I mean, I guess it depends on what age you are when you decide you want to retire at 50, and therefore your time horizon a little bit. I think what's unequivocal is the power of compounding over time. I mean, equity markets at large have delivered approximately 8% over decades and decades and decades, and a good active manager will be able to give you a little more than that. So you can be looking at somewhere between 8 to 10%, annually over the long term. I'm talking decades. And I think actually in the current environment, where inflation is higher, we come through a period, as I mentioned, where inflation was persistently low. That's not the case today. Where persistent inflation is present, I think the long time horizons, decade-long time horizons, and investing in growth equities matters even more in maintaining and growing your real capital over time. So I do think it's more important to think in decades. And what I can say is that and we should be mindful of is that investing over short periods in growth equities is a sensible outcome. Long-termism and growth go hand in hand. However, what I would say is that the growth portion of your personal portfolio, if you want to retire at 50, a portion of that allocation can remain invested in growth assets, because hopefully those that retire at 50 are going to have a long retirement, and there's still several years and decades left. So there's absolutely no reason why a high conviction growth approach like the Monks Investment Trust, if I can, wouldn't fit nicely with someone who's looking to retire at 50 and keep the value and grow the value of their capital over the long term.
Thank you, John. I've got one from Patrick Wilmot. I imagine you may not have the stat to hand, John, but perhaps the general sort of thrust of the question you may be able to tackle. So what proportion of American cars are electric at the moment? And, where will this growth come from if Trump wants to drill, baby, drill? So perhaps how you're looking at the potential impact of Trump there.
Yeah, I mean, look, I wouldn't want to be too precise about the the likely penetration of EVs over time. I think the direction is clear. The cadence of that is up for debate. Trump clearly favors old school oil and gas. I think the reality is that the move towards cleaner energy is likely to happen. And I think one thing we must remember is that it's not all US centric. When we think about the penetration of EVs globally, different markets are growing at different rates. So if you look at somewhere like China, EV growth in China is really rapid. It's the leading EV market globally. They've got huge volumes and growing penetration where there's huge opportunity. And in Monks, we own Li Auto, which we regard as one of the leading players in that field. Closer to home, somewhere like Norway has been an early adopter of EVs. And they very much lead the way from a European perspective. So I think it's right to acknowledge that inherently within the question that policy does matter. Over the near term, it may be that the adoption of EVs is slightly slower in the US market relative to others. But I think it's important to recognise as a global investor that there are pockets of very strong growth, and indeed in some cases like China and other parts of the world, the penetration is already beyond what we can imagine as consumers in some countries like the UK.
I've got a question from Jonathan Pollock. Thank you, Jonathan. How do you help educating clients on this type of investing if they are risk averse?
Well, I mean, I think it's a great question. I mean, I think, well, first and foremost, we're always very clear about what we're looking to deliver in managing, whether it be Monks or indeed any of the other growth portfolios that we manage at Baillie Gifford, and that is that what we're looking to deliver is attractive returns over the long term in a 5 to 10 year time horizon. So we're very clear that if you have capital that really matters, and you're depending on, you shouldn't put it in a Baillie Gifford Monks or any other fund if you want to secure that over a sort of 6 to 12 month time horizon. We're investing in companies, generally speaking, that are looking to grow their earnings materially over the long term, and that's the key thing from our perspective that drives the share price appreciation over time. But you must give companies time to do that. What we're not doing is trying to second guess how the stock market will value companies. Mostly what we do is try and estimate which companies are likely to deliver superior growth and where that superior growth isn't appreciated. And as I said, that takes time, and we're always very clear with investors that that's the case. Indeed, we have had some challenging performance in some of our funds over the last 2 or 3 years, but we can see our funds returning to a more promising performance pattern in recent months. But it is about emphasizing that long-term investment horizon.
I've got a question from Simon Thomas, and Simon wants to know what is the degree of overlap between Monks and Scottish Mortgage, given their sort of similar global approach?
Yeah, yeah. Well, look, that's a great question, and the overlap is around about 20%. So I think what's important to emphasize, kind of slightly akin to other questions I've received here, but the overlap is firmly that both are growth portfolios, both are looking to invest in companies that will deliver earnings growth over time. Perhaps the main difference is the kind of breadth of growth that we embrace within Monks relative to Scottish Mortgage. Scottish Mortgage is seeking to invest in the rapidly growing disruptive companies that Monks owns around about a third of the portfolio in. That's pretty much exclusively where Scottish Mortgage hunt for ideas. Where Monks is a little more broadly than that in the stalwarts and in the cyclical growth companies. Monks has a lower exposure to unlisted stocks, around about 5% of the portfolio, compared to Scottish Mortgage at about 30. And we have about similarly geared positions. So the key difference is the breadth of growth that we capture in both portfolios. Disruptive, transformational, rapid growth, almost exclusively within Scottish Mortgage. A broader suite or church of growth within Monks, which includes rapid but also stalwart and cyclical style of growth.
Thank you, John. And I think it's another one from Jonathan Pollock, actually. Thank you, Jonathan. How are you sort of thinking about investing in the US versus the UK and Europe, John?
Yeah, so good question. Today, the Monks portfolio has about 60% of its capital invested in US companies. The wider index is about 66, 67%. So we're currently underweight the US relative to the broader market. So that's the starting point. Historically, the companies that reside in the US have typically commanded a healthy valuation premium because, frankly, they have been the companies that have grown the fastest. But what we have seen in the last 12 to 18 months is that valuation gap, the premium that's associated with the US stocks relative to the rest of the world has widened so much that actually the nature of the opportunities on offer in other parts of the world are growing. So for us, we as global investors continue to look all the time at different markets right across the world, but we are and do recognize that valuations in the US do look more stretched, and we have actively been looking and investing in companies residing in other countries and other markets. So, for example, we've taken positions in Cosmos Pharmaceuticals, which is a retail discount chain store in Japan. We've taken positions in Kokusai, which is a Japanese semiconductor business, among others. We've added to B3, which is a Brazilian financial exchange. So we still think that some of the world's best companies come from the US, but increasingly what we're seeing is very attractively valued companies in other parts of the world. So we're very much maintaining a breadth of perspective in the opportunities we look for.
Thank you, John. And I mean, even sort of whether we're talking about investing or whether we're talking about sort of day-to-day business, it feels like AI is, a bit of an almost inescapable topic. How are you sort of using AI as part of your investment process? And are you finding that it's helpful?
Yes, yeah. So AI, I mean, as an investment opportunity is one thing, but how are we actually utilizing it as investors? AI has got huge potential, and I strongly suspect we're at the very beginning and early innings of that opportunity. But we do need to be mindful that it's not some sort of a ready-made solution, and you can't replace the act of real investment research. But what I would say is there's a couple of points to highlight here. One would be it's been a very helpful accelerant to what we do. So we've been able to conduct portfolio reviews and audits much more quickly than we would have been able to before. So it would have taken analysts a week, 10 days to crunch through the 100 or so portfolio holdings to generate insight. We can get AI to do that in a couple of hours. So one example would have been following the Liberation Day tariff announcements. We were able to screen the portfolio very quickly to analyze which companies might be most at risk. Where should we focus our attention and engagement with the companies to understand the risks that are at play? It's not really as easy to say that it's at a click of a button. Some of the analysts on the Monk's desk, for example, some of the prompts that they use for the AI models and tools that we have are as long as 11 pages of A4. So there's a huge amount of thought that's required to actually generate the prompt so that the AI model will give you the best outcome. But nevertheless, it can be a huge accelerant to what we do. And then secondly, I think it can elevate the level of debate and understanding we have of the companies that we own, or indeed prospective companies that we may own. So what we started to do on our desk is, before all of our stock discussions, we've been individually using AI tools to construct devil's advocates, namely papers that take the alternative perspective to the stock discussion note that we're talking about that day, and challenges the thesis that's been put forward, or brings our understanding up to speed on a stock more quickly, so that our debate and discussion in the meeting can be of higher quality. So, in that sense, it's an accelerant and it's an elevator to our discussion and the quality of our debate. So these are early use cases for us, and we'll be building out how we use them as part of our investment process over time.
Yeah, 11 pages. I imagine a not insignificant amount of prompting goes into that, John.
It was a fair amount of work that goes into that too. Yes.
I just want to remind all of our viewers that if you have questions for John, you can pop those in the chat, or you should be able to send them directly to me. If you do want to stay anonymous, my name is of course Jem Frost. So John, in Monk's portfolio at the moment, what are you sort of most excited about?
I think there's probably a couple of things here. One is to acknowledge that the period we're coming out of with Monks has been a challenging one for the performance profile of the portfolio. But the aggregate level, I think it's hugely exciting that the valuation disparity relative to the forecast growth proposition that we have at the moment, that's really compelling. That the stocks are not highly valued in aggregate, but the forecast growth is significantly superior. So at the aggregate level, that trade-off, that profile feels very exciting to us, and gives us a great deal of confidence that the future's bright for the trust. I think, if I think about within the portfolio, what are the kind of areas that excite me? I mean, we've been talking about AI. We're aligned to several structural trends in the portfolio. AI being the most obvious one. About 25% of the funds invested in opportunities that are in some way related to AI, not solely dependent on AI, but can be very profitable and lucrative holdings for Monks, given their involvement either by utilizing or being a beneficiary of AI in some way. And that includes everything from the semiconductors such as Nvidia, which everyone will likely be well familiar with, through to enterprise application software systems that are beginning to adopt AI. And again, we're in the relatively early innings here, but something like Salesforce, which is an established enterprise management software business, is revolutionizing its proposition through its Agentforce AI platform, which is going to allow its customers to better service customers more efficiently, more cost effectively, and in a better way. So gone are going to be the days of some sort of very ineffective chatbot, and in are going to be human-like interactions and problem solving for ordering and returns and customer complaints, all using the Salesforce Agentforce platform. And then, finally, I think just even at the stock level, there are just companies that I think are excellent companies. Dutch Bros, which is just one example. Dutch Bros is it's a US business. It was founded by two brothers 20 years ago, and it's effectively a coffee chain, but it's revolutionizing the coffee proposition in the US. It has around 900 drive-through stores. It's growing rapidly. They hope to add 3,000 stores over the next decade, and they're really mobilizing a very young cohort of customers. And the potential for them to roll out across the US is really very exciting. So, there's just companies like that in the portfolio that fill me with a great deal of optimism and confidence about the future.
Fantastic, John. Before we do call it a day, just want to check whether you have any sort of final message or takeaway for our viewers today.
Well, I mean, I think that I'm trying to sort of put myself in everybody else's shoes. What I've talked about today in terms of the core steps to navigating uncertainty. So building resilience, think about how that could be translated into your own asset allocation or the way that you think about your investments for clients or indeed your own personal investments. Secondly, retaining perspective. There's a significant sort of behavioral element here that I think does matter. It's very easy to act fast and move move conventionally, but just try and bear in mind that in many cases the path to the greatest returns are where investors are patient, where they're mindful of not sort of automatically believing in reversion to mean, and ensuring that you're aligned with deep structural changes that are happening over time, and try and stick with those where you have conviction that that's the case. I've already aligned or alluded to several that we think are here to stay. And then thirdly and finally, the point about being reward seeking is really important. It comes back to the point which is that in many cases the best time to be an investor, whether it's a growth investor or any other type of investor, is when there is uncertainty, when markets are fluctuating. That can often be where you can pick up some of your best long-term investments. So that's a really key point, and those principles apply to broadly to what we do here at Baillie Gifford. And the outcome, I think, is portfolios that are well positioned to navigate a range of economic outcomes and deliver strong capital growth for shareholders in trusts like Monks.
That was John Henry, everybody. John, thanks so much. There were some really fantastic insights, a really good presentation. I enjoyed that. Thank you.
Thank you.
Right. Before we do wrap up, hopefully you can see these on your screen. They are your learning objectives. So by the end of this presentation, you should all now understand the perspective of a long-term growth manager in a rapidly changing world, have considered the importance of investment discipline and a differentiated perspective in delivering a high conviction growth approach, and understand where there may be opportunities for long-term investors amid increasingly volatile global markets. Thank you, everybody, for your questions. Thank you to John for joining me. And thank you very much, everybody at home, for grilling John with your questions. If your question didn't get answered, or if you have a question you might like to ask privately, I'm sure John and Baillie Gifford will do their best to do so after the event. And before we do close up, I do just want to assure you that your CPD will be delivered tomorrow. So before we do say goodbye, let me just leave you with a little teaser of what's to come from PA events. Our next working lunch with Baillie Gifford will be on the 3rd of September. We will be joined by John Stewart, investment manager, with their monthly income strategy. The session will be all about decumulation decisions, resilient monthly income for retirees. On the 10th of September, we will be back on the road with our autumn multi-asset and MPS roadshow. We kick off at a brand new venue for us. That's Wetherby Racecourse. On the 11th, you'll find us in Warrington, and then we'll be at the Vale in Cardiff on the 16th, Bristol's Lee Court on the 17th, and we'll complete our roadshow in London on the 18th. You'll hear presentations, if you attend, from Aberdeen, Aviva Investors, Downing, Quilter, Rathbones, and Standard Life. The following week, we'll be crossing the border for our annual Scotland Investment Roadshow. You'll find us in Edinburgh on the 24th of September and Glasgow on the 25th. We'll have a great mix of presentations for you in Scotland. You'll hear from Copia Capital, Downing, L&G, Orbis, Schroders, and Tatton Investment Management. So all in all, that's 12 hours of CPD over the coming months. As ever, if you wish to find more information or to sign up to any of our events, you can do so at www.professionaladvisor.com/events. That's it for today's session. So all that remains is for me to thank John once more for his presentation. Thank you, John. And also to thank you, our readers, for joining us over the lunchtime. I do trust that you found this session helpful and worthwhile, and hope to see you again soon. Thank you very much, everyone.